I've been saying for a couple of weeks now, since we started to see the unraveling of First Brands, Tricolor, the auto parts uh, dealers, and then we saw some hiccups with some of the regional banks, that when you start to get some mainstream media coverage on what my personal perspective is a flawed business model in the private credit industry right now, where they are taking in, like the company I shared yesterday, okay, Brookfield Asset Management, and tons of other private credit, asset management companies taking in trillions of dollars from pension funds, life insurance companies, okay, sovereign wealth funds. And they're taking those monies because the lenders are reaching for yield. And they're being promised 25%, 20% from these funds. The private equity has taken these monies and they're investing it in basically failing companies that they believe or they hope or pray they are going to get turned around, okay, and then go through an IPO and make everyone a bunch of money, and of course make the general partner, the fund, a bunch of carried interest. Go back and look at the video from a few days ago about the carried interest issue and the conflict of interest involved in the carried interest. So yesterday, as I shared with you, Brookfield bought into 3 companies. Basically, they're failing. Okay, their loans are barely above the default performance level. They don't have any assets. I think one of those companies had a $400 billion loan and had $128 million of assets, something like that. So anyway, you're getting massive extensions of credit from these equity funds to these failing companies. I said yesterday, would you lend even $1 to a borrower who had terrible credit, no cash flow, no good history? No, of course you would not. But that's what's happening. So here we go, full circle. So yesterday's title was this circle of doom, and this is another aspect of it. So CNBC today, I see first thing this morning is starting to break some stories on this. And again, once this starts to go mainstream, watch out, okay? It's just the beginning. As I always humbly ask before I jump into the story, if you're not subscribed to the channel, I'd appreciate you hitting that subscribe button so we can keep growing the community. And thanks to all the new subscribers for watching. So I have CNBC today. The article is titled, "Why Private Equity is Stuck with Zombie Companies It Cannot Sell." And this touches on everything, okay? It brings it, again, full circle to what is happening right now and why I titled today's thumbnail that the losses will be staggering, because these companies are not going to turn around. They're going to go bankrupt, okay? And they're going to default on these loan obligations. And these lenders, the creditors, right, the investment funds, pension funds, private funds, private investors, life insurance companies, they're going to get probably zero. Best case scenario, they get maybe 10 cents on the dollar, okay? It's going to get really, really ugly. So the article says, private equity firms are facing a new reality, a growing crop of companies that can neither thrive nor die, lingering in portfolios like the undead. These so-called zombie companies refer to businesses that aren't growing, barely generate enough cash to service debt, and are unable to attract buyers even at a discount. They are usually trapped on a fund's balance sheet, okay, beyond its expected holding period. And look at yesterday's video. A lot of these creditors, the investors, are raising red flags. They're lawyering up. They're saying, wait a minute, why are these non-performing assets, number one, not generating any returns to us as promised, and not even close to within the time frame that we expected to be basically cashed out and repaid? So it's in limbo land. Now, as interest rates were rising, people felt they were stuck with businesses that were slightly worthless, but they couldn't really sell them. So it says you're in the awful situation where people throw around the word zombie companies. According to Oliver Harmon, founding partner of private investment firm Searchlight Capital Partners, told CNBC's Squawk Box on Tuesday, okay, when you get this stuff being put out on Squawk Box, on CNBC, it is starting to quickly, faster than I thought it would, go mainstream. Harmon added that private equity firms loaded up on piles of debt with very cheap rates in 2020 and 2021. However, central banks rapidly hiking rates in 2022 and higher for longer rates have inflated debt service costs. Private equity firms are having difficulties because the machine is stuck, according to Oliver Gottschlag, a professor at HEC Paris, whose research focuses primarily on private equity. If you don't distribute back, you don't get limited partners, right? The investors in a position where they have liquidity to commit new funds. That's number one, but also I'll add on top of that, they're also going to be reticent to do that. Even if they have another stockpile of cash somewhere, why would they commit more funds if the one they already committed to is not performing and returning anything to them? So it really is problematic, according to this guy, adding that zombie assets are becoming more frequent and harder to clear. Limited partners, okay, are also are known as private equity fund investors, right? They're the lenders, they're the creditors putting these monies into the private into the private equity deals, okay, through these funds, through these asset management companies, Brookfield, Oak Tree, a bunch of other ones like that. The logjam echoes the aftermath of the 2008, here we go, 2008 financial crisis when stale portfolios and refinancing cliffs clogged the market. According to accounting firm PwC, private equity firms are sitting on about $1 trillion of unsold assets, capital that would typically have been exited under a normal cycle. The average holding period for PE, private equity portfolio companies, reached its longest on record of 5.6 years. Okay, so these asset management companies, the private credit companies, are taking in pension funds, life insurance funds, wealthy investor funds. They're promising returns, but then these funds get tied up for, they're saying, almost 6 years now, over 5.5 years, according to data published in August from global management consulting firm VDS Consulting Group. So what's more, an increasing number of private equity investors say their capital is trapped in zombie funds, according to a 2024 survey by the major secondaries asset manager. Nearly half of institutional respondents, including pension funds, here we go, insurers, reported exposure to vehicles unlikely to exit assets or secure fresh commitments. This thing is going to get seriously ugly and fast. This backlog is colliding with the very mechanics of private equity, where funds are built to turn assets into cash by a certain deadline. That's what they promise. They promise quick turnaround and higher yield. That's why they're able to entice these investors, okay, to put money in the first place. So the whole business model, at least in terms of the investing in these, let's say struggling companies, is failing on a huge scale. And wait, as it starts blowing up, company by company, bankruptcy after bankruptcy, default after default, it's going to be trillions of dollars out there, guys. Waiting around for the undead to resuscitate is often not a luxury available to a private equity firm. Natasha Harduth and David Pinnock, lawyers from Cliff Decker and Hoffmeyer, wrote in a recent note. However, general partners, GPs, who are the firms or people managing the private equity funds, often cling, and here's the conflict. Let me explain this. Often cling to zombie portfolio companies because acknowledging defeat is more damaging than deferring it, according to CDH. So even, let's say they have an asset that they know they got to cut loose, take the loss, they don't want to acknowledge defeat because that drives down the buzz on the whole fund, right? And the credibility of that asset manager or private credit firm throughout the marketplace. So they hold on knowing it's going to fail, okay? Meanwhile, they've got trillions of dollars of investor money tied up, or let's say held hostage. Liquidating a failed investment locks in realized losses that hurt fund performance, and here we go, and jeopardize future fundraising, giving firms strong incentive to kick the can down the road in hopes of a turnaround or a better exit market. And you know, they kick the can down the road as they find a way to rework the debt packages with the failing companies, right? They put the interest on the back of the loan and come up with all this creative nonsense financing so they can basically fake their way through the portfolio to their investors, saying, well, it's technically not in default, okay, because we came up with some creative accounting mechanism to just shift it to a later date. Again, kick the can down the road. It's easier to keep the corpse politely seated at the board table than to host a funeral that invites post-mortems, right? Bunch of tongue-in-cheek there, according to CDH. The reputational dent is just a punishing. Liquidation signals not just a bad investment, but an inability to rescue it. And then you have investors, like we're seeing now, lawyering up, getting national law firms to question, look into the books. And ultimately, what happens to the private equity funds is their shares, okay, Brookfield shares trading what, 34 times PE right now on forward earnings. Guess what happens to those shares? People start dumping the shares in those funds. CDH cited an example of a stressed market like South Africa's, where there are few willing buyers in a failed sale process, can stigmatize an asset even further, making it even harder to exit. So again, you go back to this doom loop, okay, circle of doom. A failed sale process is its own horror story, carrying nearly as much of a stigma as a liquidation for a private equity firm. And because the failure becomes known, makes the asset even harder to sell. So not only does the asset itself, the failing company, become a pariah, but so does the fund, all right, itself. However, a potential ease may be on the horizon. Talking about the rise of mass affluent, and here we go. Here's the shift to the unassuming wealthy people, okay? So always looking for an out. They get into trouble here, and they say, well, let's just find a way to get creative. We got to bring in a new pool of suckers to put money in. Let me repeat that. The potential ease, right, may be on the horizon. According to this guy, Goshlag pointed to the rise of mass affluent and private wealth capital, also known as the realization of private equity as a potential pressure valve to unlock the exit freeze. Unlike traditional PE funds backed by pensions and endowments targeting 25% net returns, this new pool of capital accepts lower return thresholds of around 10 to 12% and potentially longer holding periods, giving it a lower cost of capital. So they can go to wealthy families, individual wealthy investors, wealthy funds, and say, look, we'll give you 12%. If they can only get, let's say, 4 or 5% from, let's say, their bonds or their mutuals or something else, they believe, or they try to convince these folks that it's a buying opportunity. And I will say that, let's say, in my 30 years experience as an attorney, business lawyer, contract lawyer, dealing with a lot of wealthy people, you would assume that the size of their bank account is commensurate with their investment knowledge, their investment expertise, and sometimes those things are very disconnected. All right, so these private equity firms now are going to start approaching a whole new pool, not new, but let's say they're going to focus more on the pool of the private wealthy individuals. Okay, hope if you guys are in that category, you don't fall for it. You can see what's going to happen here. All right. So don't get greedy or reach for 12%. That right? Because what is 12% of zero? It's zero. Okay. Rather have 5%, of your money. Would you rather have return of your money or return on your money? You've heard the adage. While these investors won't rush into truly broken companies, their flexibility and scale could still help unblock the temporary freeze by absorbing assets that no longer fit the traditional private equity model, he said. So the private equity firms are going to dump these non-performing zombie companies, okay, with terrible books, no income, on unsuspecting private investors. All right, many of you might say, hey, caveat emptor, that's their fault. They should do their own due diligence. And I guess that might be the point I could make also as part of this show today is if you're in that strata, you've worked hard and you've had some good fortune, you've amassed a bunch of wealth, please be careful, all right? Please be careful. For most people, we're all just kind of sitting outside looking in saying, look at this you-know-what show. All right, I went a bit long today again. Thanks for watching. If you enjoy the content, leave me a like. Please subscribe if you're not subscribed. Thoughts and comments are welcome. I will say this, the comment section is getting extremely long, and they're very intelligent comments. I'm struggling to keep up with it, but I'm doing my best, okay? But I do read them. I do get through them. Thanks again, everybody, and I will talk to you soon. Bye.